Hello and welcome to BQ Prime. You're joining us on this special broadcast where we're discussing the Reserve Bank of India's latest norms around penal charges that banks and other lenders can levy on their borrowers. Now, the guidelines that the RBI is referring to is the Fair Lending Practices Code of the Reserve Bank of India, and this applies to banks, NBFCs, or any other kind of lender that the Reserve Bank of India regulates. To discuss this topic in detail, we're joined with Mr. Raman Aggarwal from FIDC. Mr. Aggarwal, welcome to this conversation. Thank you so much for taking time out talking to us.
Thank you, and thank you for having me on the show.
Mr. Aggarwal, let me start with the first question. Now, the point that the RBI is trying to make in these guidelines is that these penal charges or any kind of penalty that is levied by a lender to its borrower is meant as a punitive measure and is not a revenue-seeking opportunity, which what the RBI sees is that has become the norm because you keep charging penal interest over and above the penalty itself, and that keeps adding up. Even in the Finance Ministry's response in the Rajya Sabha, one of the points that was mentioned is that 35,000 crore roughly has been collected over 5 years between 2018 and 2023 by the banking system. And this is just the banks. We're not even looking at the NBFCs here. But Mr. Aggarwal, I would just want to get a sense from you as to how does a lender see this when you are taking away the right to levy any kind of interest on the penalties?
So, see, Vishwanath, I think we need to understand this in the whole perspective. So, there are two aspects to it. One, of course, we need to appreciate the fact that, yes, there should not be any undue practices or unreasonable charging of any charges or interest to the borrowers. That's something which is unique and universal, and nobody can question that. And we as lenders are fully aware of that, fully responsible to it. Having said that, we also need to appreciate the fact that whatever we are calling it here, first of all, I'm restraining from calling it charges as of now. Let's appreciate that this whole is basically a factor of time. It's time value of money, right? Now, I borrow money from you, and for some reason, I am not able to pay on the due date. There is a delay, right? So whether you call it a default, I think we prefer calling it a delay. There is a delay which happens, right? Now, since there is a time value of money, so whatever is the delay, proportionately, there has to be some amount of interest paid off. Now, by nature, this has always been accounted for and treated as an interest. We need to understand this very clearly, right? Now, the moment you call it a charge, the whole nature changes. That means it is no longer a component of interest. It is a charge. It's a fee which you are charging because of the delay happening.
Right.
Now, why I am saying this is important is because you would recollect that the draft circular was issued in April.
Yeah.
And based on that, FIDC had made a representation, and this is exactly what we said. That let us not change the nature. We appreciate the concerns. That's one side, we will come to that. But let us not change the nature of this levy, because the moment you change the nature from an interest to a charge, there is an immediate implication of GST.
Right.
Now, the moment you put a charge, there is going to be a GST level. So, to expect the borrower, somebody who's delayed his payments, to pay the charge and also pay the relevant concerned GST will be a tough ask. Number one. Number two, what you're doing here is by changing the nature, you are making it a fixed, rigid proposition. Because let me also tell you one very important practical side of it, which at least we in the NBFC sector have followed all these years.
Right.
Whatever this so-called penal interest or charges, whatever you call it, is always levied in the memoranda account and is actually recovered from the borrower at the time of settlement.
Okay.
And many times when, obviously when the borrower comes for settlement, there is some kind of a negotiation that happens. Many times we have seen that these are waived, altogether waived, or if not waived, some hefty amount of cut is given, say 30%, 50%, 60% cut is given. But that will no longer be possible now, because it's a fixed charge with GST. The moment that is done, you cannot alter that. So these are two very key elements which you also need to appreciate. I think that's what we've said, that we can talk about the concerns of the borrower, how to address them, but let us retain this nature as an interest and let us not call it a charge. That's our argument number one.
Okay. I'll break this up into two parts, but first let me tackle this interest versus charge question. Now, what exactly changes for the borrower if you charge a penal interest, or if you're putting a penal charge? At the end, customer doesn't really, I mean, that person has to still pay a penalty for non-compliance.
Yes.
Right? I mean, that doesn't change anything for them. It's only the lender side of the story that changes, right? That's what you're referring to.
No, but there is one element I brought in, from the borrower's perspective.
The GST part.
As long as it was an interest, there was a possibility of a waiver or a cut happening, which will no longer be possible now, because the moment you charge GST, you've deposited the GST, you cannot change it.
Wouldn't you say?
So that is one.
Wouldn't you say? But that the RBI is trying to remove any kind of discretionary decision making in this part, and is looking to make a flat decision making process.
Yeah. So exactly. So that's why I began by saying that let's not mix the two. Let's segregate the two. Now let's come to the concerns which RBI has expressed. Those concerns we fully appreciate, and if you ask me, we agree. Right? The concerns are there. Why? It's a simple fact, because this was an area which was left open, grey. There was no specific instructions.
Yeah.
So obviously, every lender was following its own policy. Somebody was charging X amount, somebody was charging Y amount. And yes, I mean, I admit it could be in many cases, it could have been very high, I mean, which was not called for. So yes, there was a need, and there is a crying need to bring in a standardization. That is very important. Or what we've even said in our presentation is that you retain the nature in interest and you could very well cap it. So, for example, RBI in this circular also mentioned that, okay, let this rate not exceed the contractual rate of interest.
Okay.
Right? So, there was ways and means of addressing concerns. Once again, I repeat, we fully appreciate and agree with RBI's viewpoint that there are concerns. There is a need to bring in standardization from the borrower's perspective and from the regulator's perspective. But to do this, let us not change the nature. That's my point.
Okay.
We can do it retaining it as an interest.
Okay. Apart from the tax components, what is the benefit to the end borrower if you retain the nature of penalties as they are today?
So, as I said, foremost, no leeway for any discount or anything happening now, the moment you call it a charge. That's number one. I mean, the key point I would say, right? From the borrower's perspective. Now, I will slightly digress here. Now, remember the COVID era. And we all know there was a huge debate and even litigation that happened around on the interest on the moratorium period. You may remember that. And it was also an interest on interest.
Yeah.
The matter went right up to the Supreme Court.
Correct.
And you would recollect, and rightly so, that all banks, all NBFCs, RBI, and the government of the day took a stance that yes, this has to be the interest, because there is a time value of money. See, we conveniently forget the liability side. What about the liabilities which are, say, fixed deposits in case of banks and in some of the NBFCs are accepting? Can you tell if at all, I mean, normally it doesn't happen. Suppose there is a delay in repayment of those deposits with interest. Can you tell the depositor, I will not pay you the interest, I will pay you some charge?
Yeah.
No. It has to be a time value. So commensurate, and that is the stance which was taken that point. Both RBI and Ministry took that stance that it has to be an interest because there is a time value. So that's the point I'm bringing in again here, that let's not change the nature. But yes, I agree, there is a need to cap it or bring in some kind of a standardization.
How would you go about that capping? Because it's the RBI in its guidelines is very clear that certain products have to have the same kind of penalty. You can't randomly decide a penalty has changed because product A has been decided over product B. The other part that the RBI is very clear is that you have to have a board-approved policy, so it has to be a uniform process applicable across the borrower base, and that you can't charge more than what you charge your non-individual customers. You can't charge retail customers like your corporate customers you do. I think the crux of the discussion comes up to that, right? Because this system that has existed where everybody decides for themselves and they do what they feel like it has led to the situation where the arguments you're making are fair, but the effective charge has become untenable for a customer.
No, agreed. So as I said, there is one simple way. Could be you cap it. That okay, do not exceed the contractual rate. Now that will take care, because product-wise, entity-wise, obviously NBFC's lending rates are higher than banks because our borrowing cost is higher. Similarly, product-wise, the interest rates could vary. Interest rates could also vary based on the various risk profile of the borrower. That's very important element, right? So I think to cap it, for example, you say, okay, don't exceed your contractual interest, contractual rate of interest. Simple, it's done. So I think and then there is one more element, in this circular. Apart from the issue of charge versus interest thing which I raised, there is also an element of what you can call some kind of a retrospectivity, to the extent that this will now also apply to the existing loans. Now let's appreciate that the majority, at least I speak for the NBFC sector, a vast majority, except for housing loans, vast majority of the loans, in fact more than 90% given by NBFCs, are fixed rate loans. Fixed rate loans, short tenure loans for anywhere 2 to 5 years, right?
Right.
Now, in such case, to expect this change to happen on the existing loans also is going to have a very dampening impact, because the whole equation changes. So this should not be applied to the existing loans, at least for the fixed rate short tenure loans. I agree, the long-term housing loans or long-term loans which are floating rates, which are benchmarked against the external rates, fine. I mean, there is a need. But short-term tenure fixed rate loans, existing loans should not be disturbed. This is again would change the whole equation. So these are two key asks or requests we are going to make to RBI post this. We are still debating and discussing. We are having our meeting also shortly. We'll take a call on that now.
You've got about 4 months before the guidelines come into effect. January 1st is what the RBI has said.
They said that the existing loans, it will take into effect 6 months after that. So basically, 1st July onwards, all existing loans get covered.
Yeah. How much of a hit would that be for the banking or, well, the NBFC's ecosystem if these guidelines go through as they are in the current shape?
See, I'll tell you what, I don't think, if you ask me in terms of the financials, it's going to be a very big hit. No. I think let's not, I would say that at least for NBFCs, again, I can say for confidently that to say that NBFCs were making huge profits out of this element is, I think, probably would be stressing things too much. Yes, I mean, there could be stray cases where this may be happening. So I don't think this taking a big hit on the actual financials of the sector, I mean, that remains robust. However, there are going to be operational issues. If you do it on existing loans, there are going to be operational concerns. I think that will equally be in the case of borrowers and the lenders. So as I said, because as a practice, these are kept in the memoranda account and actually charged at the time of settlement. Now, the moment you change it to a charge, so what will happen to the past?
Right.
So that is, an equation which we need to sort. So there will be more often operational issues. Similarly, when I said GST element coming in, so you cannot, alter it or give it any discount or waiver. And what if the borrower doesn't pay the GST amount? I mean, he just pays the overdue charges. He says, fine, I'll pay these charges, not the GST. Then who is going to pay? So that's going to go from our pocket, the lender's pocket. So there is going to be more of an operational issue, not a very big financial impact. Yes, there will be an impact, but not something which should cause any worry or ripples in the system.
All right. Last question from my side, Mr. Aggarwal. I just wanted to get a sense from you as to, the confusion that has come up in these guidelines. Where do you think this started from, this conversation of controlling penal interest versus penal charges? Because the RBI usually starts the conversation because somebody else or somebody within the RBI brings it up as a problem. But was this something that the NBFC industry or the banking industry pointed out as a issue which needed guidelines?
No, I think if you read the circular, they've given a hint. So they've sent this during the course of supervision. So they mentioned that. So obviously, what does that mean? RBI has two elements of supervision: off-site and on-site. So off-site supervision is by way of returns, etc., the details which we file to RBI on a monthly, quarterly, half-yearly, and annual basis, and the on-site inspections which are carried out. So maybe during the course of that, they came up with this, and they found out that in some cases it could be very high. And yes, obviously that element was there, that there was no standardization. Everybody was charging on its own. So I think it was during that course that it came up.
I'll tell you why I'm asking you this, because it seems a lot like the problems that came from the digital lending ecosystem, because that became a real issue just about a year ago, where people were being charged with hefty sort of penalties, which was increasing the loan amount by 100x, and that didn't quite make sense to anybody. So I'm just curious to understand.
No, I appreciate your point and where you're coming from. So let's also appreciate that the moment you compare, say, today's banks or NBFCs, even with the digital lending concerns, there the major concern was that majority of those lenders are unregulated entities.
Yeah.
So then any unregulated entity charging any amount of interest is something which obviously caused alarm bells. Whereas in case of NBFCs and banks, we are all very well regulated, part of that ecosystem. And today, to say that somebody is charging very high rate of interest, let's appreciate, if the market is so active and dynamic today, that entity will automatically go out of business if it starts charging anything which is out of, So market, and that's the reason why RBI has openly and very rightly so maintained this viewpoint that they are against regulating or capping of lending rates. That's exactly because the market is dynamic, the regulator is dynamic. They keep changing. They keep altering the rates, the policy rates depending on the situations. We've seen in the past that some excellent work has been done by RBI, and even the Ministry of the Government of the day, they've supported fully. So I think all that is well taken care of. Those concerns primarily arise out of entities which are themselves not regulated or under-regulated.
Okay, Mr. Aggarwal, thank you so much for joining us. We'll leave it at that. Pleasure talking to you, sir.
Thank you.